Trading is one of the broadest words in finance. It covers buying a share, it covers selling one. It covers the long-term investor and the speculator in and out of the position before lunch has even started. Technically, all of them are trading, but there's a specific skill living inside of that world, and it's not what most people think it is. The job of a trader isn't to predict where the market's going. It's closer to reading the surf. A good surfer doesn't decide what the ocean's going to do next. Nobody can. They read the conditions, they pick the best wave available given those conditions, and they paddle out knowing they won't actually know whether the wave was the right wave until they're on it. If it doesn't shape up the way that they read it, they'll just get off early. If it keeps running, they'll ride it for as long as it has energy. And before it closes out on them, they'll get off on their own terms. If you really think about it, that's exactly what trading is. Reading conditions, choosing the best wave or trade available, riding it out to find out if you read it right, and knowing how you're getting off and whether the wave gives up on you early or whether you've already taken what it had to offer. This series is built around that exact framework and idea. In the trailer, I said we'd put it all together like a puzzle, piece by piece, until the picture comes into focus. Reading the surf is the first piece. Hi, and welcome back to Capital Clarity with Christian. 15 years across NAB and Westpac, now a full-time trader and a financial fundamentals advocate. Here to explain the things to you that are complex, but really they aren't. By the end of this video, you'll know what trading actually is, the two real distinctions between trading and investing, and why trading can absolutely be gambling, and is for most people who attempt it, and the simple test that you can run on yourself to know which side of the line you're really on. If you hold shares and you've been curious about what trading really is, this episode is just for you. Trading is buying and selling of an asset with the specific intention of profiting from its price movement. Nothing more complicated than that. The asset can be almost anything. A share, a currency pair like Australian dollar versus the US, a commodity like gold or oil, an index like the ASX 200 or the S&P 500, or even Bitcoin. What you're trading matters less than why. You're not buying because you want to own the asset long term. You're buying because you have a view on where price is going next, and you want to be paid if you're right. That intention, profit from price movement, not ownership, is what separates trading from investing, in my opinion. And the way the intention plays out in practice comes down to two specific differences: time frame and direction. The first difference is time frame. When you invest, you're thinking in years, often decades. You buy a share in a company because you believe in the business. You're there for dividends, you're there for compounding, you hold through good and bad quarters because you trust the company and your long-term thesis on that company. When you trade, your time frame collapses. Sometimes it's weeks, sometimes it's days, sometimes hours. The position isn't there to participate in a company's future. It's there to capture a specific price movement. Once that move is done, the trade is done. You exit, you move on. You're not married to the asset or the trade. The same person can do both. I do both. I have long-term investments that I leave completely by themselves and alone, and I have trades that I'm actively managing. They're different jobs with different rules. The mistake most people make is bringing investing instincts into trading, holding on too long, falling in love with your position, and ignoring the exit because the company is good and you're hopeful that it's going to come back. That's not patience, that's just confusion. The second difference is direction, and this one is bigger than most investors realize. When you buy a share, you can only make money one way. The price has to go up. You buy at $30, you want to sell for 40. If the share fails to 20, you've lost. There's nothing you can do about it, except wait it out and hope for it to increase or sell at a loss. Traders have a second tool. It's called going short. And once you understand it, the entire game will change. Going short is making money when price movement goes down. Okay, here's the cleanest way that I can explain it. Imagine a friend of yours owns a luxury watch. Let's call it a Rolex, worth $20,000. You believe the secondary market for that specific reference is softening. Supply is rising, demand is cooling, and you think the value is going to drop over the next 3 months. So you borrow the watch off your mate. They agree on the condition that you return an identical one in 3 months. You take the watch and immediately sell it on the secondary market for $20,000. You now have $20,000 in cash in your pocket and an obligation to deliver back the same model of the watch you sold in 3 months. Now, 3 months passes. You were right. The market has softened. The The market reference, it's now trading for 17,000. You buy the Rolex, hand it back to your friend as agreed, and you keep the $3,000 difference. That's cold hard profits back in your pocket. That's short selling. You sold something you didn't own, you borrowed it, and you bought it back cheaper. You profited from the fall. Get the call wrong, and the reverse happens. If the watch had appreciated to 23,000, you'd still need to buy one to return. That's a $3,000 loss out of your pocket. The reason this matters, as a share investor, you can only profit when markets rise. Bear markets, sideways markets, crashes, you're just a spectator. You hold and hope. As a trader, you can be long when conditions favor upside, and you can be short when conditions favor the opposite. You're not betting on the tide rising. You're choosing your wave in either direction. That's a benefit you even have over a surfer. Quick note before the comments come in. Yes, you can technically short individual shares in some markets, including parts of the ASX, but it's as clunky as it gets. And most retail platforms don't make it easy for you. In practice, trader level shorting happens through derivatives, CFDs, futures, and options. We cover those in detail in episode 2. Before we get to what makes trading different from gambling, there's one idea worth sitting with for a second, and it's the most underrated concept in this whole space. Not being in a trade is a position. You heard me right. No action can be good action. Most people who start trading feel like they have to be doing something. Platform is open, the account is funded, the charts are moving. Surely our job's to trade. Surely sitting in cash is a pure failure. Isn't. Sitting in cash is one of the highest patience, discipline, and highest skill decisions a trader can actually make. Let's go back to the surfer for a second. A surfer chooses whether to enter the water at all. They can stand on the beach, look at the swell, the wind, the way the reef is breaking, and decide, not today. Conditions are dangerous, or the sets aren't coming in the way I wanted. Or there's something in the water, deep and dark, and I don't like the look of it. That decision, staying on the beach, has cost them nothing. No injury, no exposure, no risk to their ability to surf tomorrow. They can paddle out if they want to, check out the lineup, watch every wave roll past, and never commit to anything. Also fine. They've just used their judgment and decided nothing was on offer for the ride that they wanted. Trading is exactly the same. There are conditions where the best thing you can do is nothing. No setup meets your criteria, don't trade. Volatility doesn't fit your strategy, don't trade. Something feels off in the broader environment and you can't articulate why, don't trade. A news app item is coming up soon and you're not sure which way it'll go, don't trade. A gambler can't do this. A gambler has to be in the action. The trader's superpower, and it really is a superpower, is a willingness to just sit out and lose nothing. The trade you don't take sometimes is the best one you'll take all month. Which brings me to my next and most important section of this whole episode. And it's the reason, to be frank, this whole series exists. Trading can absolutely be gambling. And for the majority of people who open an account, it is. Here's the test. There are 4 things every real trader needs. Before you enter position, you should be able to clearly state out loud all 4 of them. Item 1, knowledge. Reading the conditions before you ever paddle out. You need to understand what you're trading and what drives its price. Not the headline, not the rumor, the underlying drivers. 2, a thesis. Identifying the best wave available in those conditions and committing to paddle for it. Not because you know for certain it'll deliver, you don't and you can't, but because your reading of the conditions says it gives you the highest probability of a good trade. 3, a stop loss. The discipline to get off early when the wave doesn't shape up the way you read it. You don't ride it into the rocks just because you've already committed. You take the small loss, you paddle back out, and you wait for the next one. Number 4, take profit. Knowing how you're getting off when the ride is good. Sometimes it's a clean exit, the level you decided on before you paddled out. Sometimes it's letting the wave run whilst it still has energy and getting off the moment it starts to fade. Either way, you've decided well in advance how your ride ends. Don't let the wave or the market do this for you. Without those 4 things in place, knowledge, thesis, stop loss, and take profit, you're not trading. You're not even surfing. You're just floating around, hoping a wave hits you in the right direction. That's gambling with extra steps. Speculation dressed up in fancy software. The reason this series exists, the very reason I'm bothering to make 27 episodes, is because trading the right way is genuinely a skill. It rewards patience, study, and discipline. Done properly, it builds wealth, but slowly. It's a get-rich-slow scheme. Anyone telling you it's a fast path is trying to sell you something. So there you have it, folks. That's the foundation. Trading is buying and selling of assets to profit from the price movement. It separates from investing on 2 dimensions, time frame and the ability to profit in either direction. Choosing not to trade itself is a position, And the line between trading and gambling comes down to 4 things every time: knowledge, thesis, stop loss, and take profit. Get those right and you're reading the surf properly. Get any of them wrong and you're just out there hoping. Now, episode 2, we will go into derivatives, the instruments that make trading work. CFDs, futures, and options, what they all are, how they function, and why it's so crucial to understand them. It's a non-negotiable, even if you choose never to use them. If this was useful, subscribe so you don't miss future episodes. I'm Christian, and this is Capital Clarity. 26 episodes to go, and the conditions are only going to get more interesting from here. We'll see you in the next one.